Market volatility continues. The yield curve inverts, which brings on recession fears. Stay tuned, lots to talk about. Hello, this is Michael Loftus for Wealth and Wisdom TV, where education is the key to a successful financial future. First up, don't forget, click show more for additional information and links on today's video. Also, if you're looking for a different opinion, that of Wall Street and Big TV, please do consider subscribing. So this week, lots of talk about the yield curve. We'll get into that, which brought on talk about recession fears. We're definitely going to talk about that. So today's agenda, we're going to go over the big charts, starting with the bonds, because that's the big story, give our current trade signals, what keeps me up at night, and what's on my radar. So let's go to the big charts. All right, first up, we're going to talk about bonds because that's the big story this week. Here is a 30-year chart going back to 1980 on the 10-year Treasury. Unbelievable trend line, right? Remember those big rates tapping out there about 15%. And at the beginning of the year, I called this one of the most important charts. Why? Because of this trend line. Were we going to break through? Wall Street was calling for it. We, on the other hand, thought differently. I went back and looked at some of my old videos, and we were calling for treasuries to go down. Our yield spread, which is your 10-year minus the 2-year, has come up quite a bit, from 0.14 to 0.21. Now, I think that's a temporary situation. I use this spike up this week as an opportunity to buy more treasuries. I like this. I think we go lower before we go higher, but time will tell. But let me explain this move right here. Unprecedented, okay? When you see that move, just this month alone from 1.9, we broke 150 yesterday, closed at 152. That is a huge, huge move in the bond market. So what everybody was talking about was the yield curve inversion. I'm not going to get deep into it. I'll make sure there's a link to a video I did just on that topic. Should be able to help you out. But down the bottom, we have a couple things. One, we have our 10-year Treasury minus our 3-month Treasury. And you can see over here, it's been negative since June. We brought this up a couple weeks ago. First time we've had a 30-day below. But the big move this week, now we're at 0.04 today. We did break it yesterday for just a little bit, or the day before, excuse me. So, you know, a couple other things on this chart before I explain that. The biggest thing this week is right here, okay? So let me get rid of that one. Forgot to delete it. 1.98 on the 30-year Treasury, an all-time low. Wow, that is a big move. Again, something that we do not see. Now, the importance of the yield curve is right here. The idea is each time we've had a yield curve inversion going below zero, 10-year minus 2-year, we've had a recession. Here again, I'm going back to 1980. There's your zero line, okay? And then you can see what happens to the market. You invert. That red is a recession. Invert, recession. Invert, recession. So here we are. We had a first inversion. Probably see it again in the near future. So what does it mean to you as the individual investor? Well, the one thing it means is a recession's not coming overnight. Historically, it's been 18 to 24 months. And we don't know what's going to happen. Can the Fed have a soft landing? Possibly, right? Don't know yet, but it is definitively a warning sign that we have to be careful of. Now, the other thing that we saw last week was negative yields. Here's Japan, negative 0.23. Germany, negative 0.72. Okay? We've got 23 of 30 countries that rates are below our Fed fund rate. Again, unprecedented. Now, I was with a client the other day, and they said they watch the videos and they don't understand some things. So I'm adding, what does this mean to you as an investor? Well, the first thing is we talked about the recession. Yeah, possibility it's coming, so we have to be careful. We know that equities don't do well in recessions. Now, that being said, here's the bank index. So I had someone come in this week. They were talking with a big wirehouse broker. He said it's time to buy financials. Great value. They're underpriced. Well, sometimes things are underpriced for a reason. I mean, look at this chart right here, and you can see it, right? I mean, that is a straight down negative. Everything I look at about banks right now, negative. Why? Low rates. Banks don't do well with low rates. So this is one of the things it means to you, and also the overall recession watch, we're going to call it at this point. So let's go to our regular charts here. So we're going to start out, we're going to start out with the daily chart. Not much to say, I'll be quick. Negative. Our signal right now is negative. Pretty obvious when you look at some of the charts here. Momentum, negative crossover. Volatility at 19. Now, you don't see it here. We've already crossed the 50-day moving average, and that is your 200-day moving average, which is going to be your next level of support. So from there, we have our weekly chart. Now, what do we see here? Well, there's our channel. We broke that channel even with today's move. We're down about 1.5 for the week. But the other thing that we have here is that negative crossover. Midterm, we are negative as well. So how about the monthly? Again, we don't make this final decision until the end of the month on what we see. But to point things out that I've talked about in the past, we've been looking, on that one, we've been waiting, okay, and here you go. So at this point, momentum, we have not had that positive crossover, okay. Here's PMO, you can see a negative cross in a big way. So today, both of those are fairly negative, but I'm going to call the monthly chart neutral right now. So we have negative, negative, neutral. What does that mean to you as an investor? It's time to be cautious. Right now, we've got about 10 to 13% in cash. We're looking very sector specific. You have to be careful with this type of volatile market. Now, the next thing is when you go deeper into what's happening, and this is what we do here, okay? These are companies, the S&P, NASDAQ, small and mid, above or below the 50-day moving average. That means the price. The price is above or below the average price over 50 days. Below 40 is bearish on the short term. So we've got the S&P about 30. We've got the NASDAQ in the 20s, okay? And then we have also mids and smalls both in the 20s. Not a good sign short term, so another confirmation why we should not be putting money to work right now. Longer term, again, what we look for, here's your 200-day moving average. Same thing. Above or below 40 is negative, and what we see is S&P 49 kind of hanging in there in that neutral space around 50. Same with NASDAQ, but then you look below, and you can see I've highlighted both small and mids are below 40. That's negative overall. The last thing, this might be a little too technical for some folks. I apologize, it's what I do. But high-low percent, I'm looking for what's happening with companies, high-low percentage as far as going up or down. And if 2 of 3 are negative, that's bearish. We've got small caps below 10, that's bearish. Mid caps below 10, that's bearish. And then you have S&P only at 7. So again, another confirmation on what we're seeing right now. So next up, what keeps me up at night? All right, so what keeps me up at night? Again, let's try and tie this together. Let's move quickly. ISM, manufacturing, ugly, 53. You can see that trend, and that trend is not your friend, okay? Manufacturing is a leading indicator. Hold on, I'm looking for a chart. The next one is your global PMI. Same thing. Hello, how ugly is that? Look how many months they've been negative. Now again, what does this mean? How does it affect things? Here's transports, okay? If we're not transporting a lot of goods because manufacturing's down, it's pretty obvious what's going to happen. You capped out, lower high, lower high, lower high, and then boom. We have just broken right here a level of support. That could be an issue. Next stop may be down here. So going to continue to really watch that one. Here's another thing. We talk about Europe. We talk about how bad things are over there. The Euro Stock boom. Euro Stock Bank Index. There you go. Look at this. Look at that line right there. We're talking about a line going back to 1990. The European banks, there's a bunch of them that are in big trouble right now. Really have to watch that. So the next slide, I'm going to get a little bit detailed here. This is a time when you can pause, take a look, but let me explain what all this means. This is what we do, right? Underneath, we're doing all the research. We love our charts, but it's about the data, okay? And this shows the market, right? All the data, retail sales, industrial productions, factory orders, you name it, okay? Everything is on this list. You can go back to 2016. You see the negative numbers, but here's the thing, right? This is what we've been talking about. There's your third quarter, 2018. We peaked, period, end of sentence. Data peaked, and we've gone lower in the fourth quarter. First quarter, we're getting all the final data right now, which we know is going to be negative. And then the next thing's earnings, okay? Earnings and sales growth, actually, same thing. And you can pause this, take a look at it, blow it up. S&P, aggregate, and all the individual sectors. And the same thing here. You can see the peak right here in 2018, okay? Obvious, once you stop and look, we then go down, right? When you look at the overall sales growth, etc., when you go from 24 to 12 to 1 to 0.6. That is not a good trend right there, folks. This is what I've been talking about, and that backs it up. This is earnings through last night, 460 of 497 companies. And you can see it again where we are on slow growth, slow earnings. I think the big one here is technology, minus 7.24%. Then we have healthcare at almost 11% up. We're going to talk about that one next in What's on My Radar and Final Game Plan. Okay, what's on my radar? We've been talking about us being in an interest rate sensitive sectors for quite some time now. One of those other sectors, not interest rate, but generally does well in this part of the cycle. Healthcare. Okay, now healthcare from the beginning of the year looks pretty good, but the reality is kind of flat if you go from last year. Really been getting frustrated here. It's one of our holdings. The good news is we did bounce here off the 200-day moving average. We did see a golden cross right there. I'm just waiting. Now, we are doing and recording this live right now on Friday morning, and it is up quite a bit. Saw one of our research firms yesterday just talking about Medicare for all and potentially affecting that sector right now. So let's talk about everyone's favorite subject besides the inverted yield curve, gold. Everybody loves gold. This is as good looking a chart as we can show today. There are so many nice things here, right? You have your golden cross over here. You continue to soar higher, positive momentum. I mean, everything about this looks beautiful. Now the problem is I want to add to gold, but I'm looking for a pullback or a pause, kind of like here, which we haven't had. And you can see it correlates. That's relative strength. This shows some overbought conditions, which is where we are right now. So I'm waiting for that pause so I can add to my overall gold position. And again, we are in or out on gold. In or out based on the golden cross or death cross, your 50-day over the 200-day. And you can see it right here, okay, our golden cross, but we actually got in here in November very early compared to some other folks. So let's wrap things up with fear and greed. Andrew doesn't believe me, but I can do this in one take, the entire video. This might be the first time ever. Wrapping it up, fear and greed 2 weeks ago, 48, 19, obviously shows everyone a little fearful right now. Stats on how we get that number below. Again, our signals, 2 negative, 1 neutral. What does that mean to you as an investor? Simple. It's a time to be cautious and thoughtful on your changes and allocation changes as well. Thanks so much for watching. Michael Loftus, Wealth and Wisdom TV.